Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with Steve Foerster. How you doing today, Steve?
I'm excellent. And yourself?
Doing great. Doing great. Well, wanted to bring Steve on the show. He just released an excellent book and wanted to bring him on to talk about it. Some of my some of my favorite topics as well. Before we begin, Steve, maybe you could tell us a little bit about your background.
Sure. I'm a professor of finance at the Ivy Business School at Western University in London, Ontario, Canada. And I am an investment historian, and I've written a couple of books in the area of investment history back in 2021 in Pursuit of the Perfect Portfolio with Andrew Lowe from MIT. And my current book is Trailblazers, Heroes, and Crooks, Stories to Make You a Smarter Investor. And I'm also now currently working on the authorized biography of Nobel Laureate Bill Sharpe.
Nice. Well, let's dive right in because I know your book Trailblazers, Heroes, and Crooks: Stories to Make You a Smarter Investor. I'm certainly partial to the crook side because you learn a lot about about people and you learn about how to keep yourself safe by learning how people try to take advantage of you. So, what was kind of your favorite crook story that you wrote about?
Well, there's the classic Bernie Madoff crook story. There are some others that go back centuries, which we could talk about as well. But I think Bernie Madoff is probably the one most familiar to listeners, and there are a lot of important lessons and takeaways from that, the largest Ponzi scheme ever.
Yeah, well, let's start with that. Let's start with Bernie. So tell us what did you learn from the Bernie Madoff scandal that maybe people don't know or probably don't think about? Like, why did that happen, and what were some of your kind of aha moments in researching that?
Well, I think what's most fascinating is how long the Ponzi scheme was able to go on. Even after he was caught, it's not clear that he fully admitted to the length of how many decades this was going on for. And the unsung hero of this story, who doesn't, I think, get as much attention as he should, is Harry Markopolos, who really it didn't take him long to unravel what must have been going on. And he tried to bring this to the attention of the SEC several times over a long period of time. And it more or less fell on deaf ears. And so I think a key message is it is possible to uncover some of this fraud. There were a lot of indications that the purported strategy that Bernie Madoff was using, that he claimed to be using, involved using some derivative securities. And Markopoulos quickly figured out that given the size of Madoff's alleged hedge fund, which was actually a Ponzi scheme, um, it would have taken almost all of the derivatives that were in existence for this particular strategy to carry it off. And there would have had it would have had such a major impact in terms of the pricing of these securities. The other thing is that it's really this important lesson of if something seems to be too good to be true, it really is. The scheme of Bernie Madoff was purported to be providing double-digit returns, taking on very little risk. So imagine a classic graph of through time of an investment, and it's growing almost on a 45-degree angle with very little variations, steady returns of double digits. Well, Kirk, these things don't happen in real life. If you want to get double-digit returns, it is possible. For example, long-term investments in stocks have provided low double-digit returns over long periods of time. But something that is virtually was pretty close to risk-free, those things just don't happen.
Yeah, no, but it's so alluring though. It's so easy to get sucked in and say, well, it's only 10%. He's not promising 50, so 10% is realistic, right? I mean, well, that it seems realistic enough where it's not raising alarm, but the consistency of it sure is. But it wasn't one of these outrageous things that people talk about.
Which I think is the brilliance, if you will, of this nefarious strategy is to provide these returns that were enticing enough that might seem plausible if you ignore the fact that there wasn't any risk that should be associated with these kind of returns. I think the other thing that made it a quote unquote success from Madoff's perspective over such a long period of time is how he made it seem like it was a really exclusive club that you were joining if he honored you by taking his money and investing in the purported strategy. And we all like to be part of a club. Maybe it's this exclusive club that not all investors could be part of. And so I think that was a lot of the allure for this strategy.
Yeah, I agree. I mean, there's definitely some tribalism in there, his private club and certainly people with similar background. And of course, he was the head of the SEC at one point, or he was head of one of the
Yes.
organizations.
It was Nasdaq, I believe, that
NASDAQ.
he
Yeah.
was the CEO. So he had a great reputation, and in fact, he had a legitimate business at the time, really at the forefront, as stock trading was being computerized, if you will, and getting away from the floor trading, and that's really the success of the Nasdaq market. What's also ironic is if he had just stuck with that business, I think we would have looked at him in a very different light historically.
Yeah. Yeah, absolutely. Well, cool. So I know a lot of people already know about Bernie, so we're not going to spend the whole time talking about him, but I want to talk about some of the other ones maybe people don't know about, like Bre-X. I heard about that because I follow a lot of precious metals, and that story's come up time and again. So maybe you can tell us a bit about the Bre-X scandal because that one was interesting to me.
Sure. This took place in the mid 1990s. It was a small junior mining company in Canada, not listed on the main Toronto Stock Exchange, but a regional exchange, the Alberta Exchange. And it involved some investments in what appeared to be some very large deposits of gold in Indonesia. And so here we had a case of this small firm in retrospect, what the story was is that although we'll never know for sure, but it appears that one of the Filipino geologists, Mike de Guzman, had salted the samples with gold, making it appear that there were these huge deposits when in fact there weren't. And this went on over a number of years. And what is surprising about this particular fraud is how it just seemed to snowball, and the purported deposits that the claim that Bre-X had grew from something like 40 million ounces up to 200 million ounces without any new real drilling results or anything to really substantiate it. And so this was just a question of a company really talking up their purported results and purported deposits of gold. And there were a lot of red flags, just like in the Bernie Madoff case as well. There are best practices in terms of the sampling, how you just test part of the sample and not all of the sample, and that wasn't done, and other red flags as well. And I think the real moral of this story, and it's an interesting story as well because there's some conspiracy theory elements to it. As the story was starting to unravel, the person at the center of it, Mike de Guzman, um, took a trip in a helicopter over the dense forest in Indonesia, and the pilot heard a noise, looked back, and the door was open, and de Guzman was gone, and so an apparent suicide, and yet just like Elvis sightings, there were subsequently claims of sightings of de Guzman, and purportedly that he sent faxes and sent money to one of his five wives, which was another reveal in the story. None of the wives knew that he had other wives as well. So there's this whole conspiracy theory and intrigue, and we'll never know the full story in terms of what de Guzman really did.
Five wives.
Yes.
Jesus. Well, yeah, I couldn't imagine how, I mean, you'd have to have a lot of complexity in your life to deal with all that. If you're outside of Utah, I suppose. But yeah, that's crazy. I didn't realize he had that going on as well. Sounds like a real peach. Um, so all right. Well, I mean, I love hearing about that story. I mean, what's interesting is, I mean, if you think about like the mining stocks, I mean, you're up in Canada and there's tons of mining stocks up there. It's a big part of the economy. Um, Mark Twain, was it Mark Twain who always said, a gold mine is a hole in the ground with a liar on top?
Yes.
How does, with exception of some of the craziness at the end, like, how do you really differentiate between a good mining company and a bad one? Because it would, I can't imagine it'd be too hard to kind of salt the samples and do stuff like that. And you're leaving a lot to the imagination when you're talking about a gold mine, because there's a lot of theory about whether there's going to be any sort of metal in there to begin with. So how should people be thinking about mining stocks, as they're one of the most volatile and speculative investments in the world?
I think, and I think the industry has cleaned up a lot since the Bre-X mid 1990s. So one would hope that there wouldn't be a repeat of that order of magnitude, but never say never, because the fraud can occur in any company, in any industry. I think it's making sure that sound practices are being used in terms of trying to identify the reserves, and really focusing on the evidence. What happened with the Bre-X case was really, I think, just a snowballing in terms of the story, the narrative that Bre-X was able to control, and everyone bought into it. So I think it pays to be somewhat skeptical, and really look for the solid evidence.
Yeah, yeah. Oh, good. Um, Now, I also want to talk about the Warren Buffett and the Salad Oil Swindle. I've actually heard of that. I'm not familiar with it, but I've heard of it. Maybe you could tell us a little bit about that.
Sure. So this is a story that I would argue led to Warren Buffett's best investment, and perhaps one of the best investments of all time. And I can sort of contextualize this. So this took place in the early 1960s. It has to do with, as you mentioned, a salad oil swindle that almost took the American Express company down. And there were some unique features going on at the time in the early 60s that made American Express vulnerable. And because of this scandal, quite possibly it could have gone bankrupt. So just to step back, the crook in this story is Tino DeAngelis. He was the owner of a vegetable oil refining company. He had some association to the mafia. He had been fined numerous times for his unsavory business practices. And So where American Express comes into play is we identify American Express now as a major financial services company, and its credit card was just starting to get going in the 1960s. And one of its big products as well, something that your younger listeners might not be familiar with, but that's traveler's checks, where if we were traveling to a different country and you want and you there weren't the ATMs where you could get easy access, so you would go to a company like American Express, and you would get these checks that would be you would convert cash at that point to checks that would be honored in other countries. And so if you lost a check, it was okay because American Express would back it, and so on. And so this was just starting to gel as well. But American Express had a subsidiary that really had nothing to do with its main business, and the subsidiary were these storage facilities that one of which DeAngelis was using to store his salad oil. Well, it turned out the fraud here was that by and large, DeAngelis was getting into the futures market, trying to really pump up the price of salad oil, and expectations that there might be a lack of supply, and so he would be in a good position. But in the vast majority of these refineries, instead of storing oil, salad oil, he just had seawater in it. And this was the big scandal because he was using purportedly what was in these large refineries to borrow money and use that to invest in the future. So it almost took the American Express company down. There were questions of whether American Express would actually have to honor the losses when DeAngelis' company eventually the fraud was uncovered and the company went bankrupt. The curious thing was the structure of American Express. It wasn't the traditional limited liability company that we see today, and so in fact, investors were subject to any losses that might have gone on. So when the scandal came to light, American Express stock tumbled substantially, and this is where Warren Buffett comes into play. So Warren Buffett saw this as a potentially great opportunity. Warren Buffett, as we know, a classic value investor. And Warren Buffett, up to this point, his strategy was to look for undervalued companies, but then try to get some board representation and change the way the company was run. This was different in terms of American Express. He saw American Express as a well-run company and felt that it still had a good reputation on Main Street, even though Wall Street was hammering the stock price. So here's a key insight in terms of what makes Warren Buffett such a great investor. He decided to do his own research to test his hypothesis that American Express would get over this and that customers would still stick with it. And so he talked to bank tellers. He talked to restaurants and hotels that would be using the American Express products. And once he was convinced that the reputation was there, he started buying what he felt was a very undervalued stock. And he was all in. Almost 1/5 of his partnership was invested in American Express, and it turned out to be one of his best investments. In a year and a half, I think the stock price had gone up by 2.5 times after it got through this scandal.
Yeah, it's amazing how, if you're willing to do your research and stick through, some bad times with a company, you can really do very well because Wall Street just doesn't care. They just sell indiscriminately and say, we're out of here. We're on to something else.
Absolutely. The other interesting angle to this story is that Warren Buffett really backed management at the time who were saying, look, we're going to honor any losses for this subsidiary. That really turned around American Express and solidified their reputation. Other shareholders were against it. They thought the company shouldn't be using effectively shareholder money to pay for something that they didn't have to. And so it was this classic. We still see this today. Short-term profits versus long-term value, and Buffett was able to see where others didn't see the importance of focusing on long-term value.
Yeah. Yeah. Well, that's what makes him a good investor. And performance performance shows itself over long periods of time. So all right. Well, that's great. I appreciate you kind of sharing those. I always like to, talk a little bit about the swindles, but let's talk about some of the heroes. Now, there's one that I don't know much about, but I hear the name come up a lot, and her name is Hetty Green. And she's very well known, like way back, and I'm trying to pull the year. You probably know better than I, but the old days of Wall Street when women didn't really, partake in this industry. But she was very well known. So maybe you can tell us a bit about Hetty Green because it's
Yeah.
it's an interesting story.
Yeah, Hetty Green was born in the 19th century, and she was her family. Her father was in the whaling business and made good money there. And at the time, you're absolutely right. Women weren't associated with finances, but she learned a lot from her father and her father's business. And when she passed away, she became a really astute investor, invested a lot in various railroads and um, uh, in mortgages as well. And she was really the classic value investor, predating not only Warren Buffett but predating Ben Graham, who is associated with this particular investing style. She had this knack of being able to see when it was time to sell, when there was panic buying, and time to buy when there was panic selling. She was a very frugal investor as well. There were some fascinating stories. She was selling some stock back to a railroad company, and this was again in the early 1900s. We're talking millions of dollars, and she was in New York, and the stock had to be transferred to Philadelphia. And for this large transaction, she was going to be charged something like $100 for the transfer of these stocks from New York to Philadelphia. And she said, "Well, that's crazy. I could take a train for $4 to Philadelphia and back. Why would I pay $100?" And so that's exactly what she did. So very very frugal in terms of her investing. She played a prominent part in the so-called Panic of 1907, where there was a major crash on Wall Street. And she was able to predict that one of the major trust companies, she didn't believe that this company was going to survive. Someone asked her, "Well, why do you think they might not survive?" She said, "Well, the men are too good looking at the bank," and that was partly tongue in cheek, but she had this notion that it wasn't as trustworthy as people thought. And sure enough, within about 6 months, there was a run on the bank, and that bank went out of business. During the Panic of 1907, she was actually a major lender to New York City, which almost went bankrupt. So a really fascinating woman who I think deserves more attention, as I call her the queen of value investing.
Yeah, no, it's interesting because you hear about people who appreciate Wall Street history, the name definitely comes up, but just like most things, women don't get the credit back in the day, especially in a time when it was hard enough to be a woman in a man's world and to be that good. So um, that's pretty cool. So let me ask you some other things too, because I know your book goes into a lot of different places, and I find it fascinating. I love investing history because you learn so much. So let me ask you this, because you have a section here about Bobby Bonilla and getting paid not to play, and I think some people know the story, but maybe you can talk about it because it's to me it's just fascinating when you really kind of break down the investing side of it.
Absolutely. And I think there are echoes in terms of what happened in terms of Bobby Bonilla's contract and what we've seen more recently in terms of Shohei Ohtani and his particular contract. So just a little bit of history here in terms of in terms of Bobby Bonilla. He was a very well respected player who played for the New York Mets. Um, when he was given a contract for the Mets, he underperformed. They traded him. He won the World Series with, I think it was the Mariners, and then the Mets decided to hire him back again. And once again, he uh, uh, disappointed the club. And so in 1999, he had one of the richest contracts at the time. He was making $5.9 million back in 1999, which was near the top, if not the top in terms of salaries. Um, but the owner of the Mets decided that they wanted to buy out his contract for the next year, for the year 2000, this $5.9 million contract. And and so his agent, very savvy agent, Dennis Gilbert, was able to negotiate what we would now call a deferred payment contract, where Bobby Bonilla gave up the $5.9 million. And then after it was something like, I think, 10 years, so starting in 2010, he would receive $1.2 million each year for the next 25 years. And so what I show in the book is that really it's about understanding this whole concept of present values, and the opportunity cost. And so Bobby Bonilla was agreeable to giving up the $5.9 million because he was actually guaranteed in this deferred contract an 8% return on that money. This was at a time when government bond yields were above 5%, so a bit higher than where we are today. So the 8% was a really nice guaranteed return. Probably not as much as if he had invested it all in the stock market, but that would have been taking on a lot more risk. And so I show what really time value of money is all about, and the importance of opportunity cost. Right now, Bobby Bonilla, as we speak, is getting more to not play than some of the younger players that are on contract for the Mets. And every July 1st, there's a so-called Bobby Bonilla Day where long-term Met fans lament the fact that we're still paying Bobby Bonilla this $1.2 million. But it was really a deserved amount of money. There's a flip side to this, and this goes back to one of the previous stories we talked about. Why was the Mets owner willing to pay Bobby Bonilla this guarantee of 8%? His name was Wilpole, and he was in part agreeable to doing that because he was making great money on where he had the bulk of his money. And he was getting 10, 12, 14%. And that was in a hedge fund run by this fellow named Bernie Madoff. And so this is where he thought he was getting these great returns, so 8% was nothing. Where it turned out, as we know, not so good a deal.
Yeah. It's funny how that works, how things kind of come back to bite you when you think, well, I could just take the spread here, pay him 8 and I
Exactly.
could take 12 and it's great. Make that all
Exactly.
day. It's how Wall Street works until it doesn't.
Exactly.
Well, cool. So, um, well, this is great. I appreciate all this and the history. What would you say is your favorite story? Like, or one that we
Yeah.
haven't covered you think is really
Yeah.
interesting because you probably have a lot of history under your belt at this
Yeah.
point.
One of my favorites is one that some listeners might be aware of because it happened just 3 years ago, and it involves famous soccer player Cristiano Ronaldo. This is back in 2021 during the European Championship, and it happened at a press conference at a time where one of the major sponsors was Coca-Cola. And so Ronaldo sat down at the press conference, and there were two bottles of Coca-Cola that were prominently displayed. As soon as Ronaldo sat down, he took the two bottles, moved them out of the sight of the camera, grabbed a bottle of water, and said, Aqua, no Coca-Cola. Drink water, don't drink Coca-Cola. And on that day, Coca-Cola's market value fell by $4 billion. So this became a huge story. In Washington Post, for example, the headline was Cristiano Ronaldo snubbed Coca-Cola. The company's market value fell $4 billion. And the angle of the story was look at the impact that these influencers have. To this day, Ronaldo has the most followers on Instagram, hundreds of millions of followers. Um, so it turns out that that wasn't the real story, and so there's a huge twist that I talk about in the book, and it turns out that what happened was for technical reasons something called the ex-dividend date. When a stock has an upcoming dividend that they're going to be paying, about 2 weeks prior to that, the stock trades what's known as ex-dividend, meaning if you own the stock before the ex-dividend date, you are entitled to this dividend that's going to be paid in a couple of weeks. But as soon as the ex-dividend date comes around, you don't have entitlement to that upcoming dividend. Turns out the ex-dividend date was right smack on the day of the Cristiano Ronaldo snub. And so the price dropped on the Monday morning from the Friday because it was the next dividend day. All this major drop occurred before the press conference. So it had nothing to do with Ronaldo. In fact, after Ronaldo moved the bottles, the stock price of Coca-Cola happened to rise the rest of that day. Coca-Cola actually gained $1.2 billion. So the moral of the story is this classic correlation versus causation, and we should never correlation never implies causation. And this is a really important story because in investing, correlation really matters. This is why diversification matters. Once we put together a portfolio of uncorrelated or at least not perfectly correlated stocks, then that's as Nobel laureate Harry Markowitz showed us back in the 50s. This is the real free lunch. So that's where correlations matter. Also, many investment strategies now are so-called factor models that we should invest in certain factors because that should help us in terms of being able to outperform. And so I see this as a cautionary tale. We have to be careful with factor models because there can be associations that are not necessarily causations, and that's an important thing to keep in mind.
Yeah, no, I appreciate that. We talk about the correlation versus causation on the show all the time because there's so many examples of that, and I think people get swept up in that. As we wrap it up, I'd love to hear. I mean, you're an investing historian. What were some of your biggest um, kind of aha moments or things that you've learned in really not just the book, but just in general that that kind of surprised you? Because I think there's a lot of cognitive bias that we all have when it comes to investing. But has anything really surprised you as you've kind of gone through this research that people can take away from this?
The impact that our emotions have on investing. What's surprising is that this is not a new phenomenon. This goes back at least centuries. And I tell the story of Sir Isaac Newton, who we don't think of him as an investor, but he was, and he got caught up in the so-called South Sea bubble in 1720, and it was a classic case of FOMO. He bought the stock. It went up and he did well, so he sold out. And then he watched as the price kept climbing and had gone up by a factor of 8 times in just 8 months. And so he got back in virtually at at the top and lost the equivalent of millions and millions of dollars. So when we see what's been happening in the last 4 or 5 years in terms of meme stocks and so on, we have cases of that go back centuries, and we're often driven by FOMO, driven by our emotions. We tend to be overconfident, and throughout history we see that again in terms of overconfidence, and we often look at things with rose-colored glasses and not look at any potential downside. So what really surprised me is how consistent this is with throughout many centuries.
Nice. Well, Steve, I really appreciate you sharing your research and your wisdom with us. Um, where can people find more about you?
I have my website, stephenrfoerster.com, which talks about my current and future projects, including Trailblazers, Heroes, and Crooks, stories to make you a smarter investor, available at the usual places, also in audiobook form as well.
Great. Well, thanks for coming on the show, Steve. And for those of you who don't know, Steve's a Canadian. I can tell that because of the Sherwood in the background. Any good Canadian carries a hockey stick, so.
Absolutely.
So thanks for coming on the show, Steve. Really appreciate your time today.
Oh, it's been a pleasure chatting, Kurt.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right. Well, that was a great interview with Stephen. Really appreciate him coming on the show. I always love learning about history, as I hope you do as well. Now we're into the panel portion of the show where we have our very own Phil Weiss. Hey, Phil.
Hey, Kirk, how are you today? Good to be here.
Doing great. Doing great. We also have Jeff Hewlett. Hey, Jeff.
Well, hello, hello, and happy holidays to everyone.
Happy holidays. I'm not sure when this episode comes out, but it's prior to the holidays right now. So, Phil, yeah. So, what were some of your takeaways from the interview?
This is a topic that has always been of considerable interest to me. And when I was an analyst, I used to look for this kind of for examples of corporate malfeasance and things like that. I always looked at it from an accounting perspective. I know there's a behavioral aspect to this stuff as well. There's been so many instances of this throughout history. I know you guys talked about a few of them. You talked about Bre-X. You talked a little bit about Madoff, which probably is well known to most people. But it's a fascinating topic, and I think from an accounting perspective, there's lots of different ways to look for it. And I even had an experience with it myself as an analyst.
So, yeah, we'll definitely dive into that a little bit, Phil. So, Jeff, what are some of your thoughts?
Yeah, I like the way kind of Phil sort of teed that up. Phil's going to focus a little more on the supply side. I think I'm going to think more as a behavioral economist. I think more about the demand side. I mean, that's the part that I get most interested more in, like how and why do people fall for things that seem so obviously in retrospect, right, that's something they shouldn't have fallen for. By the way, just a shout out to Stephen Foerster. I think he's a heck of a writer and a speaker. And financial topics are tough. Now, I'll admit Stephen has an advantage. He is explaining through narrative, right? And people love stories. So stories of malfeasance and intrigue and stuff like that's a great way to tell financial stories. But he has several books. They're good books. He's a good writer. So glad that, Kirk, you could bring him on to the money tree.
Nice. Nice. Well, appreciate that. So, Phil, I got to hear about your experience, man. Tell me what happened.
Well, you have to remember that I'm a CPA. So when I was an analyst, I always looked at accounting, and I have a number of tools and metrics that I would use to look at companies. But there's also that behavioral side. And so one of the companies that I covered was Chesapeake Energy. And I remember when I first started covering Chesapeake, I thought that the CEO of the company was brilliant. I thought, like, was in an interview with the Wall Street Transcript, and I said he was one of the best CEOs in the industry. But then I kept listening to him. And there's an old book that I read that's one of my favorite books on investing. It's called Common Stocks and Uncommon Profits, written by Phil Fisher. And it's all about some of the qualitative things to look at in an investment. And in that book, Fisher has his 10 points to look at when you're looking at an investment. And one of them is to avoid highly promotional management teams. And I would listen to the CEO of Chesapeake at the time, Aubrey McClendon, talk. And he would say, we have the lowest cost structure in the industry. Well, they had the lowest cost structure because of their accounting method. And then he would say, and we have the best group of people at predicting the weather. And we can hedge better than anybody else in the industry. And one of Fisher's points is to avoid highly promotional management teams. And the more I heard Fisher say this, the more in the back of my head, Fisher started to come through, avoid highly promotional management teams. So I did one of the basic things that you can do as an analyst. I pulled out a series of 10Ks from Chesapeake, and I read the accounting policy footnotes. And I noticed from year to year that there were changes. They lengthened depreciation lives. They changed how they treated different related party transactions. They had all these really long dated hedges and all these other things. And it just didn't make any sense to me. And then they used to do these deals where when they sold property, instead of just getting paid, or instead of paying back in cash, they would pay it back in natural gas reserves. And I said to Chesapeake, that's a loan. And they said, oh, no, it's not. I said, yes, it is. I don't care if you're paying in dollars, or you're paying in natural gas. You're still paying some type of currency, because I could take, whoever you're giving that natural gas can turn around and sell it and get the money for it. And they said, oh, no, no, no. And they also did these joint ventures where part of what they got from it was that they had to spend the money or they didn't get it. So if you remember back in 08 and 09 when oil and natural gas prices tanked, Well, they were still spending hand over fist because they had to spend this money or it was going to just go away. And spending it, I guess, was better than not. But anyway, this company had a lot of problems. And I remember I used to talk to a reporter from Reuters about Chesapeake all the time. And they put out a big story about Chesapeake. Chesapeake actually told this reporter to stop talking to me because I had, my view, and they wanted her to talk to somebody that had a more positive view. And eventually, I mean, I had to sell on that company. The stock went down really low. The CEO was Aubrey McClendon. We don't know for sure, but people think that he committed suicide. He was driving at very high speeds on very windy roads and passed away. That company eventually went bankrupt. And like I said, when you look at, there's different ways to do the accounting, and like they picked the ones that were most in their favor and made them look better. And it ultimately got to the point where I actually went and spoke to some people from the SEC because they were looking into Chesapeake and they wanted to talk to me about some of the things to look for in the company.
Interesting. Yeah, I mean yeah. I what I find amusing is you've got some of the best and the brightest in the world on Wall Street, and they're all analyzing these companies. And when you really drill down to it, so few people are actually doing the work that you're talking about, Phil. They're like, oh, 10K, what's that? What does that mean? It's like, well, I talked to the CEO and he said it was fine. So we're good, right? Like,
Yes.
I mean, I honestly feel like you go to these calls, these earnings calls, and you got all these analysts, they're asking questions, and it's just like, well, I know I could probably do the work, but when I just ask the CEO, he'll give me the answer. It'll just be easy. And they're like, oh yeah, why'd you do this? Oh, okay, great. Yeah, we're good. I've checked that box. I've done my work. I feel like so few people do the actual work that when you get somebody who does the work, it's like, what are you doing, man? Why are you looking at our financials? It's shocking to me. I'll share some examples in a bit, but I don't know. What are your thoughts, Jeff? I mean, have you ever seen one of these? Have you ever studied some of these frauds in the past?
Well, when I think about it again more from the demand side, he talked to, he led off your interview talking about the Bernie Madoff, story. And it's probably one of the most popular, but most well-known stories of many different Ponzi schemes and other sort of things like that. And I love the story we just heard about Chesapeake as well. But one of the things that amazes me is, and what I've come to see over and over and over again, is there truly is no free lunch. If it seems too good to be true, it is too good to be true, sort of thing. And let me connect a dot here real quick. So the financial crisis, right, of 2008, 2009, which is just a massive. I mean, you could call it what you want. There's a major congressional deep dive into that, and pretty much everybody was found culpable, right? The U.S. government, banks, people. I mean, pretty much Congress said, yeah, it was sort of a systemic failure with all these different sort of agents that were involved, all kind of had their little piece of the fault, so to speak. And something like that's really hard to drive fault, and it's less obvious than, say, Bernie Madoff. But my point is that when I talk to students and clients and whatnot, what we really talk about is, if it is too good to be true, it probably is, and the idea of not chasing returns that are ridiculously out of context, out of view, right? And obviously, the Bernie Madoff thing was just one of those. So what I find really interesting too is, if you look at the opposite side of that, which is, hey, if something really bad happens, then we ought to sell out of it, right? And that's sort of the opposite and the same wrong problem, right? Which is, if you're invested, say, in a mutual fund or in some sort of diversified portfolio, if you look at 2008, 2009, so many people dumped out of the stock market, right? As soon as it hit, that the crisis hit. if you look at what they did with that cash, right? Maybe they dropped it into a bank account because they thought it was very safe, which they are very safe. But that bank account literally earned 0% over the next decade. And adjusted for inflation, was probably slightly negative return. It was safe, but you weren't getting anything with it. Versus if you had left it in the S&P 500 like a spider, a really boring, normal, diversified portfolio, over the next 10 years, it would have earned over 300%. So, so it kind of goes back to like that's the two sides of the same coin, right? Like if somebody's promising you 20% when really the number is probably around 7 to 8% in a diversified but higher, a higher volatility risk portfolio, then something's going on. But on the flip side of it, bad stuff happens sometimes in the short term in diversified portfolios. So if you dump out of it, your opportunity cost, like in the case of the 10 years after the financial crisis, could be massive.
Yeah, it's interesting. I mean, I've seen a number of frauds over the years, not necessarily firsthand, but just usually secondhand or third hand. I was just talking to an accountant just before this, and he was telling me a story and how one of his clients had a lot of crypto and got it stolen because I don't know what happened. I didn't get the detail. It doesn't matter. But, I mean, that's an example of fraud. But if you think of like the big examples, everyone's heard of Madoff, but also like Enron. Like I remember when I started in this industry when Enron was happening. Before I even started, when I was in college, I would read stories about Enron and what they were doing. I think it was like Fortune magazine or one of the two, one of those kind of stock promotional kind of magazines. And this big thing on Enron, it's like, oh, here's what we're doing. We're combining all the stuff, all the energy together in one pipe, and they were explaining all this stuff, and I was like, oh, that's really cool. I never invested in them, but I was intrigued. And so I was talking to a buddy of mine who worked at Morgan Stanley at the time, and he was an analyst. And we were just talking stocks, like, hey, what are you investing in? He's like, oh, we really like Enron. I'm like, oh, I've heard of Enron. Like I just started out of college. I didn't know anything about anything, right? I knew how to talk to people. I knew how to take, analyst reports and talk to people about it, but I didn't really know the ins and outs because I didn't have the experience. Anyway, so I was talking about Enron. I'm like, oh, it's a really cool idea. I'm like, I'm looking at the stock chart. I'm like, wow, this thing's done really well. Like, why? He's like, oh, it's a no-brainer, man. He's like, they do all this stuff. And he started going into all this stuff. I'm like, yeah, that doesn't make any sense. Like he was explaining to me, like he's an analyst. Like he's a new analyst. Like he and I went to school together. So he was an analyst for like a year. So he was not really experienced, but he's junior analyst. And anyway, so I'm like, I I don't know. There's something that doesn't make sense. Like why does that make like why are they so much cheaper? Or why is like he was saying all these things. I'm like, I don't understand. Why isn't anyone else doing this? He's like, oh, you just don't understand. I'm like, I know, that's why I'm asking the question. I don't understand. Why is this so much better? And he's like, well, look at the stock price, man. Like it just keeps going up. Obviously, Wall Street thinks it's a good idea. And I'm like, I don't like that idea. I don't like that example either. My dad was a criminal defense attorney, so I got to see a lot of crazy stuff. And I was growing up, I met some of his clients. Like they'd come to the house and we'd chat and they'd bring donuts and stuff. Like some really interesting experience I have. Anyway, but one thing you kind of get pretty clear is when you talk to these people and you talk to enough of them, there's a kind of uniformity of the way that they act and the way they talk and kind of what they say and how they do things. And there's definitely like an underlying thread for a lot of it. So as you guys were saying, like if it sounds too good to be true, it probably is. Like there's just certain things when something doesn't make sense, it probably doesn't. Right? If it sounds like it doesn't make sense, it probably doesn't. If nobody can explain it to you, other than like you just don't get it as an explanation, that's not an explanation. It's like Bernie Madoff. Like people would question what he's doing. He's like, "Well, you're just not a good fit for this." And so if somebody answers your intelligent question with a blow off, like, "Well, you're just not a good fit for this. Well, maybe we'll find somebody else," or I shouldn't have to explain this to you. If anybody says something like that, run. Like that's a brush off where people are trying to make you feel bad by asking good questions. And so there's a lot of ways people can get defrauded. Um, but one of the most obvious ones is people want to feel like one of the crowd. They want to feel like, oh, well, everyone else is doing it. I want to do it too. Like Bernie Madoff, he had his community, right? He had his, his country clubs, his people, like people just like, oh, he's one of us, kind of a crowd. And people wanted to fit in, like, oh, well, Susie's doing this. I want to do it too. He's part of the country club. You have all that stuff happening, and people feel like they want to be groupthink and they want to invest because other people are doing it. Um, I get it when you don't want to be left out. You're like, well, everyone but you is doing this. Oh, okay, I might as well get in. When that stuff happens, it's really easy for frauds to happen, right? Because everyone wants to belong. Um, but Enron's a great example, and you could just like Bernie Madoff. There's plenty of ink being spilt on that, so you can go back and read up on it, and you can figure out what happened and why. But the accounting stuff, the numbers, you have to like Phil, like when you're doing the accounting part, like what are you looking for? Like are you looking for frauds? Are you looking for are things just coming up and you're like, wait a minute, like how do you how do you go about it? Like how are you finding frauds and discrepancies when you're going about it?
So I think there are certain metrics that I'll look at for companies. And among them are like another example of this was there's a company called Sunbeam. And the guy that took over as CEO, his name was Al Dunlap. They called him Chainsaw Al because we'd come in and cut stuff.
I remember him.
But Sunbeam eventually got in trouble. And why was it? Because they did what's called stuffing the channel, right? And so I will look at things like days sales outstanding. So I'll call it the cash conversion cycle, which is basically how long it takes to purchase your inventory, right? Take that or your raw materials, manufacture and make it into a finished good, sell it and collect, right? So payables, receivables, and inventory values are all part of that. And I want to look at that because if that starts to get bigger and bigger, then I start to get worried. And I remember there's a different company that I covered. They weren't doing anything wrong, but I asked them, their cash conversion cycle went down. And I said to the CFO when I was at their analyst meeting, I said, hey, your cash conversion cycle has gone down. Why? And he said, thank you for asking. No analyst ever asked me that before. He says, I've got pages and pages of stuff here to talk about. And what they had done is that they had worked with their payables people, they'd worked with their receivables people, and they were collecting faster. And if they had 30-day terms, they weren't paying it in 5 days. They were paying it closer to 30, right? So because you can generate cash based upon how all those numbers work together, and they were managing inventory better. So that's one thing that I'll look at. There's something else that's called the Danish M score. I'm not going to get into the calculation, but when a company has a certain score, it's an indicator of possible fraud. There's another metric that I'll use. It's called the Piotrowski score, which is a measure of business quality. And I'll remember when I was working for another advisor and I was responsible for picking stocks. There was a company, actually, it's the same as the one that's on your hat, Kirk. And that stock was having problems and they wanted me to look at it as a possible buy. And like its Piotrowski score and its Danish M score scared me. They were that bad. And then they were like, if you looked at the actual go out in the world kind of thing, they put product into Kohl's. And Kohl's is a known discounter. And this company was not known to discount. So like that meant that they were trying to to me, that meant it was a sign they were trying to get rid of inventory. And that stock tumbled a lot. So there's certain things, those are the kind of things that I look at. You want to look for their cash flow and look at it compared to the income, because you can mess with income, but it's a lot harder to mess with cash flow. And so there's just certain metrics that when I'm looking at a company, I will look at those metrics and see how it scores on those metrics to give me an inkling as to whether it might be manipulating in some way. But sometimes, as was talked about on the call, I mean, I think you guys talked about the American Express Salad Oil story, and that was one of Buffett's really successful investments. So sometimes when things look, things happen, then you want to dig deeper and see if you can understand. And that's why Buffett was successful, because he dug deeper into that story and decided that it wasn't as bad as the market made it to be, and it was an opportunity for him. So these things are not always reasons to run away. You have to understand why.
So maybe it's the story is if it's too good to be true, it probably isn't. Or if it's too bad, it probably isn't either. It's almost like a mean reversion thing, kind of like you can kind of play both sides.
Yeah.
Yeah, I mean, it definitely brings in the fact of, what is known to the market versus what isn't, right? And, when a lot of these frauds, it's a question of what do people actually believe? Like, people believed Enron was going to the moon. It's like the Nvidia of its day. It's like, hey, it's just going to keep going higher and everyone's going to make tons of money and it's easy money. And it's like, all right, well, that's a bad sign. If people stop thinking, right? And it's like, oh, I'm just going to go all in on I'm going to go all in on red. And it's just, I think that's,
yeah.
But so Jeff, talk to us a little bit about the, I guess you call it the demand side, but talk about the human nature part of this. I talked about the groupthink, the bias with the groupthink, but what else can get people into trouble with frauds?
Well, I think, especially in a corporate environment, the groupthink thing is can't be kind of overstated, honestly. So, and there's a number of different examples of that. Let me give you one example from my past. So I've been on the buy side and the sell side some too, but mostly on the buy side of bond sales, right? And so mostly RMBS, ABS, so basically consumer loans, mortgages, that those sort of packages, right? And so there was this, it was a pretty well known but kind of nefarious sort of activity that would happen with these bond pools called pool stuffing, right? And maybe it was sort of like the stuffing that Phil was just talking about, but the pool stuffing was basically where, the way buyers, at least at 1,000 feet, bought bonds was they would look at weighted average characteristics. So they'd look at the weighted average credit score, the weighted average yields or WACs, the weighted average, balances, debt to income. You name it. Imagine all the things you'd want to understand about a bunch of loans. You had a weighted average measure for that stuff, right? And so the way it would work is these sellers would basically find their crappiest loan, and they knew that, based on the law of large numbers, that you put one loan in a pool of 1,000 or 10,000, even if it's a crappy loan, it's not going to pull on those averages very much, right? And so maybe it would stay above some threshold that everybody says, as long as the FICO score is above 700, it's all good, kind of thing. So anyway, so that was pool stuffing, right? And it happened all the time. And the crazy thing is, you would think mostly the banks buying them would be all over it. And generally they were. But remember, there were also end investors buying these things too, right? So it wasn't always just the bank. It could be a mom and pop. It could be some, municipality out in Iceland who was trying to get into the American real estate market, whatever it is, right? And so, but, the crazy thing is that, and it kind of goes back, I think, Kirk, to what you were saying is how deep do you want to look, right? So when I was buying, I would basically say, give me your 10 crappiest loans. I want to look at those, right? And we would do a full due diligence on the worst loans, and we would look at other measures way beyond averages, right? Obviously looking at variances and kurtosis, so, all the kind of think of all the statistical moments, but going out in the moments to figure out what's in the tail and things like that. But we were so in the, the minority I think. And then as a result, we passed on some pools that others were like, I can't believe you walked away from that. That looks awesome. And we bought into some pools that, at that 10,000 weighted average level looked, marginal, but we could look at it because we got into the details we could understand and we could buy into and felt like we were getting value, right? Whatever par price or premium to par we were paying, we felt that we were buying something that was worth more than the street thought it was worth. And the crazy thing is that shouldn't be possible, right? Like if the way market economics works, it's supposed to work is all the information gets loaded into the price. Well, guess what? Sometimes it does. But a lot of times it doesn't. And sort of the way it worked in my organization, at least, is that's kind of how we made our money.
Yeah. Yeah, no, it's good. I mean, I think one of the things when I was thinking about is I've got a experience about 10 years ago. I had a client, an elder client, family friend, known him for a long time. And he got it kind of falls into the category of like elder abuse, like elder financial abuse. It's kind of borderline. Anyway, I learned some interesting things. So um, it so happened that this guy was basically commission bombing him with stuff that's totally inappropriate. This guy's older, stuff he should not have been in, and they're trying to bamboozle this guy. And he's a nice guy, and he just wanted to be nice to everybody and didn't want to upset people. So he's like, "Oh, okay. Well, he said it would be fine." And well, it turns out. So I look into this and it turned out it's just this bag of crap that he's trying to sell him. Big commission sales, doesn't care about the client, just totally the wrong thing to do. Anyway, so I start calling around because I'm trying to figure out like how do I get this guy noticed? Like because he's doing this, because that was his pitch. Like he's like, oh, I'm an expert in working with older people. I'm like, well, that means he's doing this to more than one. So I reach out to a few people, called the state, um, and it turns out that there's really no. They talk about elder abuse, but if you really want to report it, there's really no good pathway. Um, I talked to the state. I forget which offices I talked to, but I kept getting the runaround, like, "Oh, sorry, we don't do that. We don't do this." Eventually, got forwarded to like the state police. Ended up talking to them, which I thought was kind of a weird place to send me. I talked to them. They're like, "Oh yeah, we'll look into it." And of course, they're not looking into it. It was just a brush off. But the point was, is you have these things that happen, and while you've got all these government officials doing God knows what, nobody's actually sitting there and saying, "All right, I'm going to look at this." So we had an experience probably like I don't know, 15 years ago. It was close to when we started the firm, and we had a client who came to us, or prospective client at the time. They're like, "I want you to look into this. I want to invest in this thing." So we look into it, and immediately my partner's like, "This is a fraud." Um, and it wasn't necessarily because we knew it was a fraud, is because there's certain things you go down the checklist these people hadn't done. And one of them was like filing, I don't know, it was a Reg D, but it was some sort of regulatory filing they had to do. And they didn't do it. So he called the guy. He's like, "Oh, do you have this filing?" He's like, "No, we didn't do it." He's like, "You're supposed to, right?" He's like, "Yeah, we're just not going to." That was his answer. It's just a lot of money. We're just not going to do that. Now, this is not something that's going to catch somebody. Let me be clear. This filing is not going to catch a fraudster. They were just being cheap about it, and they weren't going to file the thing. So that was the first red flag. And then my partner, obviously, when they said that, he's like, "Well, I'm actually going to look into this because this is a local thing. There's other people locally, not for us, but he knew the people in the area, so he asked around, and they're all saying the same thing. Oh, you don't want to work with that guy. That guy's shady." Anyway, so we put together a file of all the stuff we found, and to my partner, it was clearly a fraud. And so we brought it to the SEC and said, "Hey, we've got this. We can't share the information because it's client privacy stuff. But if you request it, we can give it to you. Like, we're following the rules and all that." And so he's talking to the SEC, and they're like, "Yeah, I guess just send it to us." Like they had no interest in pursuing this. And so 2 years later, front page, the paper, like big fraud, Southern Mass, like, 20 million lost. I forget the number, but this is going to my gray matter. Like 20 million lost to a fraud. And then we get a call like a few days later from the SEC. Oh, see in our notes here that you guys know something about this. Like, we told you about this 2 years ago. But the problem wasn't that they ignored it. Here's the problem. What they said to us is, has anyone lost money? Well, if you know anything about frauds, no one's actually lost money until the day that everyone loses money. Like, you're like, no, it hasn't lost money. Here, you can have your money back. I mean, it's all bullshit. But the point being is, like, the rules and standards that have been set up are to catch from people who've already lost money. Well, if you'd known about Bernie Madoff and you report it, like Harry Markopoulos's story, you report it and they're like, well, has anyone lost money? Well, I don't know. I don't know what everyone else is doing. I just know this is a fraud. And they won't look into it because no one's technically lost money. And so I don't know if it's an SEC problem or a regulatory problem. I don't know where the gap is, but my point is there's a huge gap. And I don't think a lot of people are aware of this, is that the gap exists. I don't know if it's because the SEC is funded to be the cleanup crew, but they don't have a lot of exploratory crew. Like, they look at people like us, like we're registered, and they'll look like us and people like Phil, and they'll say, all right, let me check your stuff. Like, we routinely get checked out every few years by the SEC. It's just everyone does. And they look through your books and look through all their stuff and be like, all right, this is clean, or you got these problems, you got to fix it, right? That's their job, is to proactively look at advisors to make sure they're doing the right thing. And they do a good job. No fault on them whatsoever. But when you get into these areas of, could it be fraud or could it not? I don't know if they're really staffed for this. Like, they probably have people on staff, but I don't know if they're staffed to really dig deep into do like what Jeff and Phil are talking about, is really explore, like, is this really a fraud? Right. Because not only is it hard, but you got somebody like Harry Markopoulos who's uniquely skilled to discover this, where most people are not. So right. I think there's kind of a gap in the regulatory body where they're just not structured to find these frauds. So when they come out, like, why didn't the SEC do more? Well, we don't have enough funding. Oh, we'll give more money, and then it doesn't get solved because they don't get more money. If there's, if you solve all the problems, what's that line from Wag the Dog, where the fixer gets the head of the CIA in the limo, and he's like, I have the satellite footage. There is no war in whatever country they're claiming. There is no war. And he goes into this long monologue about, if there's no war, then why do we need you? He's like, have a good day, sir. So, it's just kind of proving the point that if everything's perfect, you're not needed, right? And so there's this dance that goes on. But it is interesting to see that there's all these little gaps of quote unquote fraud that can happen, and they're not really well explored as to how to prevent them in the future, and maybe not staffed. I don't know. I mean, what's your thoughts?
I also think, though, Kirk, there's, I don't know, to me, fraud, like, we talk about it almost like it's a single known thing. And in my mind, there's a slippery slope between they did some bad stuff to fraud. It's just sort of on this curve, right? And what elevates to be labeled a fraud versus it was insincere or was certainly harmful to the end consumer of the product or whatever. I kind of go back to, so I'm a banker by trade, right? A lender. I've been in consumer lending and commercial lending, but the consumer lending side has this super strict and time tested, really since the 1970s, body of regulation around consumer lending, like fair lending, Reg B, Reg Z. So there's this whole corpus. And by the way, since the financial crisis, it's even gotten corpier, if that's a word, right? It's gone kind of over the top in my mind. But anyway, but the point is, and then the lending organization not only has the regulators like the OCC, they also have the CFPB, whose sole job, which who knows what Trump's going to do with it, that's another question, but assuming they exist, their job is to watch out for that kind of bad stuff that happens to end consumers. Well, when I look at the SEC and FINRA and sort of just the overall investment side of the house, they lack all that in many ways. And I think perhaps the SEC would not only say we don't have enough people, we actually don't even have a regulatory legal mandate to do some of this stuff that, yeah, it's intuitive, but there's no law that we can point to that says we should do it, right? And I don't know. I not that I want to give the SEC a pass, but there's also a side of it that is sometimes I worry that we actually don't even necessarily have a legal, like they don't even necessarily always have a legal hammer that even if they had the money that they could kind of go after people with the way we do, at least in my sort of lending side of the bank balance sheet.
Could I take that a step further too? Like, start of my career, I worked as a tax guy, and I did a lot of corporate tax. And I remember when the IRS would send in, some of the companies, like they have the IRS there all the time, right? Because they have ongoing audits. And one of the things that I was told was when the IRS asks a question, just answer the question. Don't go any deeper than that. The reason being
Right.
that the people that they had working for them, I assume it's the same as the SEC. They don't necessarily, I'm not talking about the top, but the people that are out in the field. A lot of times they don't have the knowledge to know what else to ask. So the reason we were told to only answer the questions they asked was because if we didn't tell them anything else, they wouldn't know what else to ask us. And so I think that's part of it too, is that the people in these agencies that are there to do this review, they're not the people that work for companies. They're not the insiders. They only have book knowledge, and they don't know all the other things that can happen. So they don't ask all the right questions. And a lot of this stuff comes back, like, I talked about Al Dunlap, and like, that comes from, it used to be like, especially in the late 90s when we had the tech bubble, like, there was the earnings number that you had to hit. Then there was the whisper number, which was like some other number, like that's what the street really thought was going to happen. But there was so much pressure on companies to hit earnings that's what led to some of these things that caused these frauds. And the problem is it's like a vicious cycle.
Right.
Once you start, now you're kind of stuck and you can't get out, and it gets worse and worse and worse. I mean, hopefully, but at some point somebody figures it out. But the problem is, as you said, Kirk, a lot of the analysts aren't looking at it. And the people that are, if we think about the regulatory bodies, they probably don't have the people that have the necessary knowledge and experience to apply everything.
Yeah, it's funny because when we had our SCC exam like a year ago, like we had three guys in there. We had one guy running it, we had a second, and then there was a third guy, and it was like, why is there a third guy there? Well, because we do crypto, we've got a kind of a crypto breakout in what we do, and we have a guy in our team that specializes in crypto, and so because it was such a new thing, they weren't in there to be a pain in the butt. Like most people think, well, they're just in there to make problems. Well, no, they were in there because they wanted to understand what we were doing. Like, because they didn't have a clear. My understanding of it is at the time that they came in, the SEC did not have a clear definition of what they were going to do. Like, they weren't clear, like, oh, here's how we're going to regulate this. At the time, the guy was just in there. He's just asking questions. He's just like, I could tell, like, he just wanted to understand what we were doing. And he probably had a sense of like right and wrong of this is good, this is bad. But he asked us a lot of really good questions. And he's like, so what about this? And we're like, no, we don't do that because of this. What about this? No, we don't do this because of that. And so we clearly defined our scope of what we did and what we didn't do, because we're also fiduciaries and we're on the hook for problems. And so we clearly defined the road. And we said, no, here's what we do. He's like, why don't you do this? He's like, because it's illegal and we don't want to take custody. And we went through all this stuff, and he was like, okay. Yeah, like he was totally satisfied with how he did it because we had a very well thought out process. But I think there are also a lot of advisors who are just doing it because of like, hey, it's easy, it's crypto, and like let's just, clients want to do it and we'll help them. So I totally agree with what you guys are saying, that there's it's not necessarily that they're informed or uninformed, or I think it's just, I mean, I was looking up the definition of fraud because this part always makes me chuckle when somebody gets arrested or convicted of fraud. It's like, well, what kind of fraud? Like, wire fraud, mail fraud. Like they got Al Capone on tax evasion. They didn't get him on all the murders and all the other stuff racketeering he was doing. But it's funny. So when they get some of these people, they get you on fraud, but it's usually like mail fraud or wire fraud. It's like you're not. It's because the crimes themselves, even though they're wrong, may be really, really difficult to convict you on. So they get you on some other
Right.
charge that also has teeth, like mail fraud and wire fraud. It applies to anybody. If you put
Right.
something in the mail, if you send somebody money, that's mail fraud or wire fraud. If there's any fraud attached to that sort of corpus, if you will, to the whole entity. So that's how they get you. Even though you might have done some shenanigans over here, they can't really get you on that, but they can say, well, you kind of had shenanigans, but all this other stuff you did, we're going to get you on all this other stuff. To me, that I find fascinating. And I can't remember Sam Bankman-Fried, what they actually got him on, like what the actual
Right.
charges.
Being an idiot, I think. But
Well, but here's the thing. So I didn't follow this closely enough. So take that with a grain of salt. But yes, he was an idiot. But I also feel like they targeted him. Now, I'm not saying he didn't do anything wrong, because I think clearly it came out that he did. But I don't think he deliberately tried to defraud people. I think it was just like he was just an idiot, like you said, and he just like, well, I'm just gonna commingle. But they didn't get him on commingling. They got him on, like, I think like wire fraud or mail fraud. And it's like that's what they get everybody on.
Right.
And what puzzled me about him was people didn't actually lose money. I think, like, I don't know what the result was, but I think it came out like there's actually extra money. That that
Hmm.
that there was more money than there were claims. So it just kind of made me wonder, like, what did we miss? Like, what? Because usually when there's fraud, it's like, oh, there's like $100 million missing, and it's like I heard, and I could be wrong, that there was an excess to take care of the people who lost money. So did they lose money? I don't know. So I guess my point is, it always makes me wonder when they throw around these blanket terms of what actually happened and what did they get them on, and why didn't they get them on all this other stuff? That's always a question that puzzles me too.
I
But
think Kirk, that they lost money when it started, but then crypto came back, and that's
is
how
that
they
what it
ended
was?
up with surplus.
Okay.
I think
Yeah.
that's what it was.
Yeah, and
So
then
as
people
long as
were
they
claiming,
stayed in, they were fine.
yeah, and they were saying, well, we're just going to take the crypto, we'll give you cash. Like, no, I want my crypto back. Yeah, there was that
at its
lawsuit.
current valuation, right?
Yeah, I
Well,
think that was that lawsuit, because a lot of people were. I mean, I'd be pissed too. Like, you took my crypto
Right.
and it's up like 5x. I want my crypto, not the money. And I think, I don't know if there's a
Yeah.
lawsuit pending on that, but I know there's definitely people who are fighting it because of that. Which I get.
Well,
I'd be mad too.
well, hey, Kurt, let me tell one other quick story if I could. I don't know. Do we have enough time?
We got 5 minutes. We
5 minutes.
got less
Okay.
than
This
five
will.
because we got to wrap it up. So
Okay. Well, just the Schwab story. I want to tell that really quick. So everybody's heard of Charles Schwab. They have a robo advisor, and basically they ended up doing a settlement with the SEC a couple years back because of how they were advertising their, how they're advertising their fees. They're basically saying there's no fee, but they were putting it into a cash account, and then they were requiring the cash account, and they were sweeping it to their bank. Their bank was lending it, so it was really a very backhanded way of making money. Plus, then of course, since you're required to hold cash, you basically couldn't invest that cash the way you wanted to see fit if you're using the robo from a portfolio standpoint. So anyway, all that stuff went down. So about a year before that happened, I picked up on it. I'm kind of a robo advisor sort of person that focuses on that for my class as well. But I signaled both the SEC and FINRA. I wrote them both. I didn't even know who to write about it. I said, but guys, this is absolutely bait and switch. If there's a definition of that, that is what's going on here. It's wrong. Nobody's even talking about it. Actually, Schwab seems to be proud of how they're advertising this, but that it's just what they're doing. And then, a year or two later, the lawsuit hit, and they took their lumps for it. I think they ended up getting them on like that FTC bait and switch, which is a very old sort of legal standard around marketing and advertising. So I'm kind of going back to, I have no idea if my complaint actually triggered something. It could have been me and a million other people that they were getting. But yeah, at the time, I was like, this is wrong. I petitioned them. I just sent it in through the website or whatever. And sure enough, a couple of years later, they paid up. So anyway, so maybe sometimes it actually does work.
Well, that is the thing. That is something, by the way. You'll never know if your thing triggered it or not. I have noticed they're just like, all right, we'll take this, and then you don't know if it turns into something or not. But anyway, we got to wrap it up in the interest of time. So, Jeff, where can people find more about you?
So I'm the founder and president of Personal Finance Reimagined. We're at financerevamp.com. We're a decision-making and financial education platform. Our mission is to help people create a consistent, repeatable decision process for a lifetime of wealth. And also, Phil, I'm a professor at James Madison. If your daughter or anybody in your family wants to take my class, I'll be there for them.
Nice. All right, Phil, where can they find more about you?
So one other thing I just want to add before I get to that, Kirk. So you asked how you find these things too. Another story we didn't talk about was Theranos, which was a company that had like this novel way of drawing blood. And I remember time I was invested in a company that was in the same business. And I called and said to them and their competitor, what do you think about this? They said, it just can't be possible. Because if you factor in the cost to mail these things and move around the samples, it's more than what she says this cost is. So like sometimes a simple phone call asking somebody with knowledge. So that just meant to me, it was less of a threat. Like Theranos wasn't investable, but it was just less a threat. Sometimes just when you hear things that don't sound right, ask somebody that has knowledge. That can also help when it comes to fraud. As for me, I know that experiencing big life transitions can be stressful. My job is to help empower women facing new beginnings with the financial knowledge and tools they need to make self-assured decisions. My firm's Apprise Wealth Management. We'd love to get to know you. If you're facing a new beginning, you can take our Flourish Through Life's Big Changes assessment at apprisewealth.com/assessment to discover how ready you are to embrace and thrive through your significant life transition. You can also sign up for our blog. Thanks for having me today, Kirk. Enjoy the conversation.
Yeah, thanks for coming on, guys. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.